Welcome to this webinar. My name is Javier Paz, and I am with forexdatasource.com. And I understand that you folks are here to learn a little more about the intricate selection process that is selecting a broker, and that's where I want to spend the next 30 minutes. You can have a more clear idea of how you're interacting with the Forex or FX market at large. All right, well, super. Let me just give you a little more background about myself. I was the head of institutional sales at a very large broker, Interbank FX, and my job there was to bring hundreds of introducing brokers and money managers, individuals that had a pretty sophisticated needs or large group needs, and basically I made sure that their needs were accommodated, and in that process, I was able to go through a lot of times when an individual, had situations that were expected, some that were unexpected, some were good, some were bad. Basically, got to see in a very short period, a couple of years I was there, a lot of interesting opportunities to understand this market from an insider's point of view. So that's what I hope to give you today. 2 years ago, I left Interbank to launch my own web research firm where we analyze all brokers, and that is what we do. One of the main things that we do. So we hope to. I hope to give you a good sense of how a broker operates, and again, be able to help you make a more informed decision. So let's get started. A broker, I'm going to be pointing here to this graph. This chart that you see in front of you displays the flow of orders from you, that is symbolized by a black dot on the left-hand side of your screen. These are the traders. There's thousands of traders typically on every broker. Every broker typically handles hundreds of thousands of orders every month. Most of them are very, very small. There is an interface, what is called a trading platform, that acts as the bridge between you, the trader, and the broker. It is an application, a piece of software that it's programmed to, some are better than others, but at capturing your intentions to buy or sell and then transmitting that electronically through the internet to the trade servers of the broker. So what happens here is that the order, let's start at this following point, which is before you even click buy or sell, you see prices in your screen. They come from the interbank market. These are indicative prices. From the moment that you execute them, then they become firm prices that the broker seeks to confirm. So, first of all, the broker is gathering prices from multiple liquidity providers or banks, brokers that are maybe bigger than itself, that are providing it the prices. That's what we call liquidity. So what you see here, I don't know if you can see my mouse. So you have liquidity providers here on the right-hand side of your screen, some of which are interacting with the broker, and there's the majority of them. Let's say, for example, if this market is made up of, let's say, 1,000 different liquidity providers in the world, some bigger than others. I mean, the really big ones are about 12. And so your broker probably works with a few of these. If in the worst case scenario, they have one bigger broker that is providing the liquidity. And then there is the vast majority of the FX market that you're not interacting with. They're not part of the liquidity pool that you're operating with. So that's something important to understand, that the interbank market constitutes both the banks that your broker is dealing with and the banks that your that your broker is not dealing with. So you're looking at a subset of the market. So then there is a device called the API, or Application Protocol Interface, that the banks provide to the broker to then stream the prices to within the broker's back office. This is what I call the bridge interface. It's this green symbol that you see next to the liquidity providers. Now, this is the connection that the broker has with the interbank market. So from here, the broker grabs prices, which then he puts, he or it puts through a price engine that then, let's say they show really tight prices. Maybe they may want to widen the prices so that they can then show a price quote that is, that allows them to make money. So let's say they see a spread of 1 or a spread of 0 on the euro, but they widen it to show a price of 2 or 3 pips in the spread. So that's how they capture that. When a trader buys or sells, they capture the spread, and that's how they make money. All right, but right now the price engine produces a feed that then is broadcasted through the platform. The trader initiates then an order request, which then has two potential methods of execution. One, the broker may send your trade to the bank that is acting as a liquidity for confirmation, or they may choose to, if let's say, for example, an order is really small, chances are this order is not going to the interbank market. It's most likely being offset, netted internally within the broker, because big banks, frankly speaking, they don't like smaller orders that have a low nominal face value. It just clogs up on their systems, and it does not allow them to operate as efficiently. So that's, let's assume then that the trade did go outside of the broker to get confirmation. Then within a matter of milliseconds, the trade that you put in, it passes, it moves physically from your IP location where you're looking in Malaysia or whatever you're at, and it transmits then to the trade server, and then on to the trade server of the bank, and then back to the broker, back to you, saying order executed. Or at that point, that is one of the main sources of frustration for clients, for traders, when this process of the order traveling back and forth, in a highly moving market, say after a news announcement, the time for travel for the order request becomes relevant, because the price is moving, and by the time the order request gets to the bank, the price has already left or moved on to something else. So then there is a requote situation that nobody likes. But again, that's kind of like the logic of how the orders travel through the internet. If you have a slow connection to the internet, chances are you may get requoted often. So something to keep in mind. And then also the back office of the so as I was saying, what explains the speed of execution from broker to broker is the sophistication that a broker may have in the back office. How much have they invested in making sure that the orders are executed super fast? And again, you will be able to tell good execution from poor execution, not just, brokers that do have a significant difference in how well they execute a trade request. Some have co-locations all throughout the world, others don't. Some have invested heavily in technology, others haven't. So when you're doing your research, you do want to kick the tires and basically ask questions to the extent of, so what have you done to facilitate speed of execution in my part of the world? That would be a fair question to ask to a broker. All right. So then let's assume that the order went through okay. So you get a response from the bank. It says, yes, the order is good. And then you get your confirmation in your platform and you're on the trade. Great. Now just understand the following. A broker done the right way, it has a sophisticated collection of systems and technology solutions within their back office. They have trade servers that they need to keep updated for thousands of accounts, reporting requirements. They have to keep track of swaps, which is the interest that the traders earn. They have to interface it it has to be connected with the accounts, servers, the web servers, particularly if you have a web-based trading platform. And there's also other system logic that goes into providing good service to clients. So this graph that you have seen here then just goes to say a broker should have a level of sophistication in order to man or to control this level of platforms, of trade execution. There are a lot of companies out there who are relatively small and unsophisticated, yet they're taking broker orders. And a client may not know much about these firms because they don't publish much information about themselves. They're not regulated per se in any reputable jurisdiction. And that's where, again, you're starting to move away from a situation where you should be feeling comfortable about the trading environment that you're in. Now, there's also another thing to consider before we move on from here, which is what I call the perverse use of technology. This was a problem more so in the past, from 2000 to 2006, 2007, where many firms basically ran dealing desks, and just because they could use technology to achieve their ends, they abused the system, and and clients got the short end of the stick and got really hurt by the perverse use of technology. You can do so many things with technology that, and again, there's a lot of theories and myths floating around the web about what a broker does or doesn't do. I would like, now that I've been wearing this independent hat for 2 years, unaffiliated to any broker, I can tell you that many of the myths out there are just pure fiction, and I think that most brokers, out of necessity, have had to clean up their act, and if they haven't, the information is being transmitted very quickly within the web, where they're not in a position to take advantage of the FX opportunity. All right, well, let's move on and then discuss how you and the broker make money. So right now you should be able to look at a chart. I think everybody is able to see this. Is that correct? Okay, super. Let me go ahead and then move on. So in this first scenario that I'm presenting here, let's say that you're looking to trade the euro against the dollar, and you see a quote, and you can tell this is a little dated quote because now it's 20 big figures higher, 127 to 103. All right, so how did the broker come up with this number? Well, this is, again, the indicative prices that they're generating. When they show you this price, they don't know whether you're going to buy or sell. So they have to provide you a price that they can deliver. And they do so by constructing it from multiple banks. So say, for example, Bank 1 gives it 0102, Bank 2 gives double figure and 01, and the Bank 3 0203. Well, And by the way, the little dash represents the difference between the bid and the ask price. So the bank then says, okay, I am getting the lowest price from bank 2 and the highest price from O3. So they combine the two in this scenario. I mean, every broker may have a different algorithm to how they construct a price in their in the price engine, but this is again one very possible way in which they're doing it. So then they have some logic in terms of the feeds that they get at any given point, and as the price changes, they update that, and they can choose to update the prices that the client sees or not. So, I mean, a broker in reality that has multiple bank feeds may be seeing prices change thousands of times per minute, but maybe they're only showing you, they're making that price that you see maybe 1 tick per second or every 2 seconds. So in reality, you know, the market is moving very, very quickly, and brokers have to make a decision, again, of how quickly they want to show a price, and also how long they want it to last. Because some brokers, for example, will say this price is valid for 3 seconds. Others say what you see is what you get. And so in essence, you know, it really boils down to the business, a business decision on the part of the broker, ultimately on the price that you see and how long it's available for. So, and other brokers, by the way, especially those that provide the MetaTrader platform, within the MetaTrader platform, you can decide that whether you are willing to accept slippage to the tune of 1 pip or 0 pip or 2 pips. You can say activate that feature in the trade execution box of MetaTrader. So not all platforms have that, but again, ultimately, what you're trying to achieve is execution that you're comfortable with. You need to understand what you have in front of you so that then you can decide, okay, this is abnormal or this is normal. You know, basically, you just need to understand enough to know whether you believe that something it's out of line. Okay, so let's say you decide to buy the euro at the price you're given, 127.03. So the broker this particular broker that we're discussing here in this example is offsetting the trades, your trades, with the interbank market. It's not keeping the trades in-house, okay? So it's not a dealing desk. It's moving the trade forward. So they will mimic the same trade that you put in. So if you say buy the euro, they will buy the euro from the interbank market. And that way they will remain neutral to the position that you have in your particular trade. The difference is, though, that they will do so at a better price than you will. And that's not only are they going to get the spread, but they're going to get a price improvement, most likely, over the price that they quoted you. So again, that's what is reflected here on the original balance. Let's say you start with $10,000. The broker charges you the spread for the round trip. That's when you buy and you sell the trade. So minus $30 from your account. And I'm assuming right here a 3 pip spread on the euro. Each pip is worth $10 on a standard account. So that's how you come up with $30. So that's the fee that the broker charges you to put on a trade. So then the broker is able to make another $20 from the price again that he's seen from the interbank market. Now, let's say time goes on and the trade moves on your side. So now you want to get out of the trade. You're in the money. So now you see a quote of 127.99 to 128.02. You see again the broker is looking at an improved price than what he's showing you. But again, you're getting just your straight price. I mean, and you really shouldn't care too much in terms of whether the broker has any price improvement or not. I mean, if they're done their job well, they should get the price improvement. That's part of how brokers can legitimately and without harming you make money in this market. So then what you have then is you get out of your trade, you booked $960 or 96 pips on your trade. The broker didn't come out of the broker's pocket because he had sent both trades when you got in and when you got out of the market. He basically just mimicked the trade that you were putting on, and the money came from the interbank market. Somewhere somebody had an offsetting position. And the funny thing here is that the broker may have started a transaction with one bank and closed the transaction with another bank, which this really shows the power of the interbank market done well, which is there's people that need to buy and some people who need to sell the currency, banks, corporations, hedge funds, investors. And these needs are overlapped in the interbank market. And again, these relationships we call FX brokers allow an end user possibly to make money without causing his broker, to pay for this. Now, when there is a dealing desk broker, there is a different scenario here. There is not an offsetting transaction that is going to the interbank market. What a dealing desk broker will do, and I'm not going to get into all the details of that because it really varies from broker to broker that has a dealing desk, how they manage their book. They will typically want to offset buyers and sellers in a particular currency, and they will just manage the net difference of that they have. So let's say, for example, in their book of clients, there's 1,000 traders, for example. Let's say 700 are selling the euro, 300 are buying the euro. So at that point, they have an offsetting situation of 400 traders. Let's assume they're all trading at the same amount. Okay. So at that point, they have to decide, how do I want to manage this risk? Do I offset it in the interbank market and basically send a trade for the difference, or not? And then again, that's a very internal decision. You and I probably will not know the answer to these questions. All we will know for a selected few brokers is that from month to month, for example, there's about 15 brokers that are regulated by the NFA that publish monthly capital figures that we can follow. If we see a big drop in the capital of a firm, it could be because either they have acquired a firm or because they've had a bad month in trading. Now, there could be, and let me tell you this, I've seen enough changes in the capital required reports of brokers. There could be huge fluctuations for dealing desks. Some months they may make a boatload. Other months they may lose their shirt. The scary thing is that you don't know if it's an unregulated broker. You cannot know whether they are making big bucks or they're close to going bankrupt, like we saw with Crown for FX in Switzerland. So again, that's where doing your due diligence makes sense, and it's something every broker, every trader should spend the time in understanding who they're dealing with, how they operate, and again, trying to get a feel for, is this broker going to be around, a year from now? All right. Well, that's again in this situation. We've talked about the broker operations, how the moving parts within a broker. We've talked about the transaction, a very simple transaction of buying and selling a euro. Now let's move on to another thing that is important in the broker selection process, which is, how do I select a broker based on what I just told you? And the answer to that question is, it depends. My MBA professor used to say this: Anytime somebody asks you a question, just answer, it depends, because most likely, that's the correct answer. And in this case, it is. And the reason why is this. And some of you will invariably ask me which is the best broker out there. And I will tell you, it depends. And the reason why is because not every trader has the same needs. And that's, what is the best broker to me, given my risk profile, my preferences of where I want the broker to be, will be different than you in Malaysia or in Russia or in Africa. So it really depends on you. And my challenge to you is understand what are the 2 or 3 things that are most important to you. Is it the fact that the broker has to offer automated strategies? Is it that you're looking for a super high leverage, 400 to 1, 500 to 1? Is it that you need to be able to trade during news releases? Is it that you require the lowest possible spreads? Or is it that you don't like spread volatility and you want fixed spreads? Do you want a broker that has offices in your country? Do you want a broker that is regulated in U.S.? Are you comfortable with a broker that is unregulated? Many people are. Do you require a dealing desk model, a no dealing desk model, an ECN model? ECN refers to brokers that have a straight-through type of transaction, that basically are defined by having very low spreads. Typically, they will charge a small commission for the trades, but lower than the overall spread for a regular broker. But again, the ECN brokers have, what you may have here is a situation where you have trade-offs. The broker that you like is an ECN, for example, but they don't offer the charting capability that you're looking for. Or, they may not have chat support in your language. So really, that's where I think the proper way of selecting a broker begins with understanding what is the most important to you. This list that I'm showing you in this screen shows some of the key variables that we help at Forex Data Source our clients understand what is really important to you. When they've run out of time or frustration not knowing how to select a broker, we do have a service where we help them provide a one-on-one type of solution where we help them do that. Now, after you've selected the filters, the key criteria that is important to you, then you use that to narrow the list of brokers from, say, 100 to 50, 150 to 100 brokers to a more manageable size of brokers. So something 2 or 3 would, that then you can look at this 2 or 3 in depth, and then ask them questions, take the time to interview them, and feel good that they're going to meet your needs. Then you go ahead, you select one, and you start trading on a demo account. Then you upgrade it to a mini account, and provided that you're able to have a consistent level of success in your demo, then in your mini account, then you move on to a standard account and you start putting on bigger trades, all in line with your trading plan, which you should have. And then again, as things are predictable, are going according to plan, then you're saying, okay, yeah, you evaluate after 6 months, is the execution that I'm getting, the service that I'm getting from these people, from these brokers that I selected, the right one or not? Then that's how essentially you systematically are going through selecting a broker, understanding how they operate, and then evaluating whether they are doing what they're supposed to. Now, keep in mind that if you lose money, is not necessarily because the broker is trying to take the money from you. Chances are there's a lot to be learned about FX trading, and you just need to dedicate yourself to apply yourself more and study more to become a better trader. blaming the broker is all too easy, when somebody loses money, but there's legitimate times when a broker should be scrutinized, and there's other times when really the trader should look at the mirror and find out, whether it's somebody else's fault or is their own. So at this time, I will open it up for questions, and wanted to see what you may have. I think we are okay for another 5 minutes with questions. So one of the questions from Buki is, do you think there's stop runs? I think there might be. There's certainly brokers out there that we track that have a bad reputation for execution. I think that's something that cannot be ruled out. The question is, how do you detect it? Because and what you've learned today will help you understand a lot in terms of how the trade goes through from the time you push buy or sell to the time you get the order back. You also need to understand how to read a trade log in your trading platform, so that you can then try to understand again if you're getting the price that you requested or not. It says, what do you think of 5 decimal brokers? Any advantages, disadvantages? Frankly, I am annoyed by 5 decimals, and I don't think it matters so much that I would go to any broker because they offer that. It seems that more and more futures brokers are offering a Forex. Will traditional FX disappear as the NFA takes over? I think, frankly, that the market is a big portion of the market has moved away from the U.S. Because of the NFA. I think the NFA may have an agenda, which is to make spot or over-the-counter FX to go on exchange. So just like the futures market, where there is only one price and they can regulate them much more easy. It will not be an easy task for the NFA to accomplish that. And they put a lot of barriers, and they keep doing that, just increase the capital requirement even more, 20 million plus 5% of customer deposits. That's a tremendous load for anybody to follow. So they're trying to weed out more and more of the remaining 14 brokers out there. So the scary thing would be if other organizations like the FSA or the Swiss or the Japanese brokerage regulators would start to follow suit what the NFA is doing. That would be scary. All right. What about brokers who guarantee no recourse? Anybody who guarantees anything, you should try to understand exactly how they do that and put them to the test. And again, do what I described: demo first, mini account first. Don't try to bank on put money on that guarantee unless and you do it gradually. It says, some say it's preferable to buy day trading platform as opposed to platform like MT4, which is free. What do you take on this? I think MT4 platform is excellent. It's by far the most popular platform in the world right now. It used to be only 55% market share. I think now they roughly have 70% market share. Other platforms like Ninja, the Ninja trading platform is very good quality, and it really depends on whether the trading strategy that is riding on these custom platforms like again Trading Station or any of these premium platforms. They do have some advantages in the studies you can do, in the charting, or in the automation, and that those are real benefits that MT4 does not necessarily offer. But MT4 is not. I use it for my daily trading, MT4, so I frankly don't miss any of the other ones. Do brokers unduly encourage traders to make more trades, since that's how they make money? That's a good question, and yes, typically they will and they should encourage traders to to trade more because that's how they will make money. But more than just trade for trading's sake, they should encourage. They should provide resources for traders to actually make money, and that's how anybody, again, if they're making money, they will trade more. So, but yeah, that's why many brokers offer a mini trading contest so that people get excited and trade a lot of money live. Do you think a trader should have more than one account? Yes and no, depends. I think it's not a bad idea to have accounts in two different brokers so that you can move the money back and forth. If you see any problems, that is perfectly legitimate and allows you to know whether the execution you're getting in one broker is on par with what you're getting on the other account. Again, assuming that you enter into a trade at the same time. Which UK broker allows the use of MT4 platform? If you go to our website and do the broker comparison tab, you'll be able to select broker by region as well as by that provides MT4 platform. Why do brokers offer big leverage knowing traders will fail rather than trying to keep traders for the long run? Well, it's really about a marketplace where they're not putting a gun on any trader to take the big leverage. They can call any trader can call and request to have low leverage. Typically, a trader with a smaller account will want to have a bit of leverage to make it worth their time. Whereas a trader with a big account will want to have a slow leverage to maximize the life of their account. Those are the two typical crowds that a broker is trying to please. But again, it's really a personal decision how much leverage you use. Our website is forexdatasource.com, and you can find it in the FX Street profile. You mentioned that a broker won't lose money if a trader wins. How about market makers? Yes, the broker that will not lose money if a trader wins is the no dealing desk broker or the ECN broker. The dealing desk broker will lose money if you make money. It's a zero-sum game. Chances are, again, but and that should be taken with some context, because what if the broker, the dealing desk broker, has offset your, the trade that their overall position has had in the market. So when they pay you out, it doesn't mean that it's necessarily coming out of their pocket. It just comes out of the offsetting situation that they have, where they have buyers and sellers. It can get a little complicated, but they don't necessarily lose money. But it does come from them because they are your counterparty. All right. Well, I think we're just about ready to wrap it up. Maybe I'll take one more question. And I invite you to come and visit the broker section of FX Street. We've written a couple of articles there in the education section, and also come to our site, Forex Data Source, where you can customize your news, as well as be able to do a lot of extensive research on brokers. Thank you so much for your time. I appreciate it. And Maud and everybody in the FX Street team, thank you so much.